What do you make of the reaction we're seeing in markets right now, in equity markets right now, on the back of developments overnight?
Right. Well, I've been at the Jefferies Hong Kong conference this week, and so most investors I've talked to have been amazed how little the markets have been reacting to what is obviously major geopolitical events. And the explanation of most, including my own explanation, is that markets have become used in recent years to seeing these geopolitical events as buying opportunities. So I think that's the explanation for the remarkable complacency. But that clearly means that the longer this conflict goes on, the bigger the risk that it hits markets. And the fact that Donald Trump has delayed his trip to China is a clear indication that he's not doing, would seem to suggest anyway, that he's not going to back off or do a taco anytime soon.
Brent crude currently at $112, and it's been above $100 for several days now. How high do oil prices have to be, and for how long before you see perhaps a structural re-rating of the U.S. market in particular?
Why would it re-rate? Re-rate.
Is there?
My big, in the short term, this conflict will be probably a relative positive for the U.S. market relative to more energy-dependent countries. I agree with that, and it's put a short-term bid for the U.S. dollar. But my own personal opinion, if you want to own one stock, let's say this conflict goes on for the rest of the year. Let's say there's a massive increase in energy prices across the globe, and these rising energy prices fundamentally damage GDP growth globally. Then, in my view, the best market to own, equity market to own in the world during such a period is the Chinese mainland market.
Why?
Because the Chinese mainland market will be least geared to those negative developments. China has a decent supply of oil reserves, and China's made dramatic advances in renewable energy, which means that China in reality has almost unlimited access to cheap power. And this has been a major development in China in contrast to the U.S., where in the U.S. you see this major bottleneck on electricity power generation, which is causing this huge ramp up in trying to invest in energy in the U.S., whereas in China you already have an incredible huge surge in power generation based on dramatic improvements in renewable energy, improvements in battery storage technology, which means, based on what I've been hearing in recent months, that solar has now become cheaper than coal in China. So China is light years away ahead of the US in terms of energy, and energy is probably the key sector globally.
And Chris, when you talk about China, would you say that you buy the dip, and what in particular is looking attractive in China?
Well, I'm viewing the Chinese stock market as in a slow bull market, which is also what the Chinese government wants to achieve. Basically, the market bottomed in end of about September, October 24 at about 7 times earnings when we were fully discounting the deflation. Since then, we've basically been in a rising trend, but the Chinese government has been very anxious to avoid what's happened to all previous Chinese bull markets, which ended up in boom-bust cycles. So you're seeing ongoing pressure on Chinese companies to boost dividend payout ratios, to buy back shares, and very importantly in the mainland market, they seek to be preventing an explosion in supply in terms of IPOs. And you also had the national team playing a role. So I believe in January this year, to cool down the market, the national team sold about half their ETF holdings, so I'm told. And, now that the market then subsequently corrected, I was in China last week, I heard that the national team had started buying again. So I buy into this sort of slow bull market narrative. Meanwhile, in Hong Kong, which is obviously appendage to the Chinese story, that's where you're going to get the more and more evidence of Chinese companies listing in Hong Kong, which are already listed in the mainland. And in terms of the Chinese economy, we are, yep.
Go ahead.
No, just in terms of the Chinese economy, clearly we've been in deflation for many quarters. Nominal growth's been lower than real growth. But one good thing right now is CPI and PPI has started to get less negative. CPI has gone marginally positive. And actually one perverse positive side effect of this ongoing Iran conflict, if it continues, is it's likely to cause PPI to go positive. And in my experience, mainland fund managers are very focused on PPI, and PPI going positive will be viewed bullishly in the domestic Chinese market and will raise hopes that deflation is ending in China.
Chris, if the war persists, if oil prices remain elevated in excess of $100 a barrel, how should investors be positioning to hedge stagflation, for instance?
Well, yeah, in equities, I think the best way to position is to own Chinese stocks. Otherwise, clearly, you have to continue to own energy stocks. So to me, those are the two single best hedges. Gold is okay too. I've been very bullish on gold, but my short-term, my tactical view on gold, which I said at my presentation this week's conference, is I believe gold has entered a consolidation period. The signal that gold has peaked for now is that it did not make a new high on the outbreak of this conflict. So I kind of mentally view gold as in a trading range between 4.5 and 5.5. And I think that may extend for a period. Meanwhile, the gold mining stocks, which have performed incredibly over the past year, will also be in a consolidation mode because the higher energy costs will impact their margin. So in my view, best way to hedge this is to own energy stocks and, in terms of geographical allocation, be as overweight China as you can afford to be.
How much gold should you be holding? Should you be holding more gold in your portfolio?
Oh, no, well, I've been owning gold for years. So gold's, I put a target of 3,500 on gold back in 2002. So to me, gold's finally reached the levels it should have reached years ago. Long-term gold can go much higher. We are moving to a de facto gold standard globally because based on current gold prices, central banks globally now have more in gold than they own in U.S. Treasury bonds. So that's clear evidence that no one's announced this. It's just a de facto move to a gold standard because central banks have been buying gold ever since they were shocked by the move to freeze Russia's foreign exchange reserves back in early 2022 when the Ukraine issue blew up. So, yeah, the central banks have driven this gold bull market.
You talked about how you've been surprised by the complacency in the market. If all the risks are being priced in, where should markets actually be? How should they be looking at? What levels should they be at?
Well, I would look at this more like at the VIX. So the VIX, when I last checked it, was well below where it was both in the pandemic and in the tariff taper tantrum. And so we can definitely get back to those levels on the VIX if this thing gets worse. But the key issue really is, the key issue right now with this is, are the US going to put troops on the ground? I think markets have been hoping for a TACO. And so far, obviously, the TACO has not happened. And so the markets are finally waking up to the risk of more escalation. And what's prompted this scare overnight is simply Iran, I think, responded by the attack on this energy facility because of the attack on its own facility. So none of this should be any surprise to anybody. The Iranians made it extremely clear before this whole thing started that if they were attacked, they would view it as an existential risk and it would be all-out war. And they made it very clear they would attack U.S. military bases in the Gulf regardless of the collateral damage. So that's what's been happening.
We saw the Fed standing pat overnight. Do you think high oil prices would eventually force the Fed to start tightening?
Well, I think, yes, at some point they'll have to acknowledge that, but I'm not surprised they stood pat over the night. I think more important than the Fed is the Treasury bond market. So long as the Treasury bond market remains well behaved, then the Fed will not be forced into tightening. So I think we need to keep an eye on the 10-year Treasury bond. But for now, the 10-year has been relatively well behaved. I think that the central bank where monetary policy is now important for markets is the Bank of Japan. The Bank of Japan's behind the curve in tightening, and the BOJ should, but I doubt it will, should take advantage of the excuse of this war to do what it should have already done, and that is raise rates in Japan. If they do not raise rates this week, they're increasing the risk that the yen breaks through the key technical level of 160 against the dollar.
How soon do you think that will happen? Because the BOJ did stand pat today.
Well, they made the wrong move. If the BOJ should have raised rates without telling the market, that would have been very positive. It would have caused the Japanese bond market to rally and the yen to stabilize. So I think that's a major error on their part. I think they should have raised rates even if this war wasn't happening.